And as we looked at last time, with gold outperforming every other asset class, bar none, a rising gold price has not gone unnoticed by fund managers who have never looked at gold investments before. And this massive move into gold has only just begun. This is the point. February alone evidenced an all-time record high of 4.9 billion flow into gold funds alone. And that so far, and that's, we're talking about US funds. And so far, it looks like March is going to exceed that significantly. Now, this gold has to come from somewhere. And with demand competing with Asian investment demand, and that it is bolstered by rising prices, so higher prices gets people more interested in buying more gold, just as it did when gold took off from 2000, when the Shanghai Futures Exchange launched back in March 2024, driving an $800 rally.
The gold market is on fire, and the signs of an unprecedented breakout are everywhere. Prices are climbing at a pace we haven't seen in years, and behind the scenes, something seismic is unfolding. The paper gold system, the decades-old mechanism that has kept gold prices artificially suppressed, is cracking under the weight of surging physical demand. Central banks are scrambling to secure real gold, the LBMA is struggling to deliver, and the COMEX is distancing itself from the chaos. But this isn't just another price rally. This is something much bigger. The very foundation of how gold has been traded and manipulated for decades is shifting, and experts are sounding the alarm. The era of artificially cheap gold may be coming to an end. Central banks, mostly led by the People's Bank of China, have been buying gold at an unprecedented rate since at least 2022, driving a massive rally and awareness among investors. While this is still ongoing and not expected to wane anytime soon, there is a new bigger fish in the pond. According to renowned metals expert and whistleblower Andrew Maguire, this new buyer is no other than the U.S. Federal Reserve, which, in preparation for the coming Fort Knox audit, has been quietly amassing gold. In addition, fund managers have entered the fray, struggling to secure a portion of the available supply before the crisis is blown widely open. Maguire suggests that the activities of central banks and the new buyers are so strong that they played a key role in the LBMA's recent default. Maguire also touches on the role of bullion banks in this evolving crisis. While they act as agents for the Federal Reserve, every single major bullion bank is simultaneously long on physical gold for its own books. This contradiction suggests that insiders understand the direction the market is heading and are positioning themselves accordingly, anticipating further price surges. As we present clips from Maguire's video, in which he shares powerful insights into the gold and silver market, please take a little time to share and like this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope you enjoy the video.
Yeah, Shane, it was tariffs, Trump's tariff mandate that really caught the Fed flat-footed. And the sudden race to repatriate paper gold positions into safe haven first-tier gold exposed the inelasticity of the available physical bullion at current prices, meaning there just isn't enough bullion at current prices, meaning that it has to be bought back at higher and higher prices. Now, we previously posted the link and took apart the LBMA video. You remember this video that the LBMA came out and they were saying, oh, yes, the idea, 8 to 10 week refiner delays for COMEX compliant 100-ounce bars. They're just related to COMEX exchange and, really trying to spin it as, no, there are no real shortages. That backfired. And it drawing really unwanted attention into the real extent of the global supply shortages at current prices. And despite allowable double accounting rules, making the true extent of the supply problems, hiding them, it's been the failure to physically load out the 400-ounce standard bars from the Bank of England LBMA vaults into a Basel III NSFR T+1 delivery protocol. It's that it hasn't moved that's really exposed the true scale of these delivery defaults. Now, we've previously drawn attention to the largely ignored GC, it's called the GC4 enhanced delivery contract. We spent some time looking at it, which enables a local London 400-ounce bar to remain in the London vaults without physically moving to the US vaults, yet it's counted as there. Now, these flows also synthetically assist in closing the EFP spread, i.e. the spread between the paper price and the physical price. As an example, we witnessed this into an attempt to block central bank buy stops at spot 3,000 from getting tripped off last Friday the 14th. We knew that Asia would come in and take it, and sure enough, they did. Now, these failures to deliver have not gone unnoticed by competing central banks who have doubled down on targeting and locking in COMEX registered inventory for delivery, alongside locking in exchange for physicals at the AM and PM fixes for Basel III compliant market delivery. So in other words, central banks and sovereigns and the large buyers need a fix. So you might intraday it be higher and lower, but usually it requires an actual fix to mark that to market. So a large size to market. So into all of this maelstrom of bullish inputs, the Fed trying to prioritize 400-ounce bullion repatriations ahead of an upcoming US Treasury gold audit is something that would never have happened had Trump not taken the helm. Now, these repatriation efforts have made it very risky to short sell paper gold into such large physical demand. And it's what has driven the unnaturally widened EFP spreads, the paper spread to paper to physical spread. And in other words, the paper price being so much higher than the physical price. And it was gapping to levels not experienced since the 2020 COVID refinery lockdown. And the EFP spreads simply represent the higher cost to close out an unbacked paper bet against global facing deliverable gold and silver. And I should add that while the Fed employs agent bullion banks to do their heavy lifting, every single bullion bank, without exception, is actually long bullion for their own books, i.e. they act as an agent. But this is where it gets really interesting. US market Basel III compliance on July the 1st will have as dramatic an effect on the gold price as when the FX gold market was brought into compliance on the 1st of January 2023. So in order to comply, the audit will have to be concluded well before the July compliance date. Now, the realization that hundreds of tons of underpriced paper market positions will have to be marked to a market price where a real seller of a fully owned bar is actually willing to put it on offer. What it does is telegraph much higher true supply-demand prices because they're not going to be paper diluted. And to give an idea of the scale of the next move higher, in line with what we projected when the FX markets became Basel III compliant in January 2023, the minimum next staging point for spot gold to rally was projected at 3,000. Now in sync with what our liquidity providers say, we project it will ultimately cost an extra 3,000 to buy the same ounces of gold, forecasting a minimum of 3,300 gold price by the end of the second quarter. That's very conservative. And a realistic 3,500 by the end of the fourth quarter. Then we're looking at very large moves higher.
For years, renowned precious metals analysts like Rick Rule have been talking about gold's reversion to mean. In his analysis, Rule observes that precious metals currently constitute between 0.33% and 0.5% of North American investors' portfolios. Historically, this allocation has averaged between 1.5% and 2%, with peaks around 7% during the 1980s. He posits that a reversion to this historical mean, where investors increase their gold holdings to these average levels, could lead to a substantial surge in gold demand, potentially tripling or quadrupling it. Maguire believes this movement may have started already with fund managers, who have historically ignored the precious metals sector, now scrambling to get in some of the action. In Maguire's view, this, coupled with the unprecedented consistent buying by central banks, will contribute to higher gold prices throughout the year. Let's get back to the interview.
And as we looked at last time, with gold outperforming every other asset class, bar none, a rising gold price has not gone unnoticed by fund managers who have never looked at gold investments before. And this massive move into gold has only just begun. This is the point. February alone evidenced an all-time record high of 4.9 billion flow into gold funds alone. And that so far, and that's, we're talking about US funds. And so far, it looks like March is going to exceed that significantly. Now, this gold has to come from somewhere. And with demand competing with Asian investment demand, and that it is bolstered by rising prices, so higher prices gets people more interested in buying more gold, just as it did when gold took off from 2000, when the Shanghai Futures Exchange launched back in March 2024, driving an $800 rally, which really railed against every top caller at the time. Now, with an increasing percentage of futures market bets moving into the hands of funds seeking long-term exposure to gold as an alternative first-year asset class, it's forcing bears to fold bets against gold and driving the 50-year unbacked paper to real physical gold gap to close. And as we know, many funds are not able to hold physical gold, so they buy shares in COMEX-related ETFs and exchange-traded funds. And these bets are seeking exposure to gold. But they're sticky in nature and unable to be rinsed, as you say, into even when they rig synthetically constructed wash and rinse cycles. In fact, quite the opposite. People have figured the game out. The change in behavior is what we're evidencing here and now. And the physical facing market making insiders are aware and taking advantage of this bullish structural change in the composition of historically unbacked futures markets, becoming backed. And the fresh in-house demand is also competing with the Fed, trying to race to buy back underwater leases at market ahead of the July 1st Basel III compliant deadline. And why would it expect more attempts to cap 3,000 gold into large derivative bets being marked to market into options expiry next Wednesday? And first notice comes directly after that. And then the April contract then expires. Now, or these people are going to have to fully fund these positions for delivery on Friday the 28th. Ultimately, there's far too much offsetting a fresh safe haven buying evident at current prices for the cartel to sustain any lasting downside traction. Yeah, if you recall when we recorded our March 5th episode 2 weeks ago, silver was being capped at, it was $2 lower at $32, where it was pretty obvious that capping at $32 into a strong demand undersupplied global market was going to become way too difficult, as insiders were being forced to short cover so as to accommodate New York dealers actually taking physical delivery to cover their COMEX short exposure. So alongside large backdoor loanouts, this was really forcing the price higher. And now the battle for $34 is there, but once rinsed, liquidity providers are seeing little resistance until the 38s. Now, and that's just short-term stuff. It's not realized that silver will be a major beneficiary of US market Basel III compliance. So liquidity providers see that the cartel's critical upside breakout level is very low hanging above 34. So they may be closer to 35, but it's low hanging and ready to be triggered. And spot silver is readying to breach massive short stops above that level. A pit close above 34 should trigger large short covering process to begin. Now we're looking for clues for the breakout into the massively expanded exchange for physical spreads. They're starting to contract. That's the clue. It's getting very risky shorting silver into a 4-year and growing supply deficits and very strong Chinese and Indian demand. And while these spreads are volatile, as the fight plays out, narrowing spreads are telegraphing an imminent upside breakout. And while these spreads have been as high as $1.38 per ounce, capping at this level expanded the EFP spreads to as high as 86 cents just this week. to try and block 34 from getting filled. But each risky, asymmetrically imbalanced spread will continue to narrow into very strong Asian buying next week, making it very risky to short silver.
What we just heard from Andrew Maguire is nothing short of explosive. This isn't just a rally, it's a full-scale market shift. Gold isn't climbing in a vacuum. It's being driven by record-breaking inflows, central bank accumulation, and the complete breakdown of the paper manipulation game. In February alone, $4.9 billion flooded into gold funds, and March is set to blow past that. This is institutional money, funds that historically ignored gold, now diving in headfirst. Why? Because the system is breaking. The decades-old scheme of unbacked paper gold dilution is unraveling in real time. Central banks, sovereigns, and institutional giants are locking in physical supply at key price fixes, while the Fed scrambles to repatriate gold ahead of the July 1st Basel III compliance deadline. And let's not forget, the very banks that once shorted gold relentlessly are now long on gold for their own books. That tells you everything you need to know. The battle for $3,000 gold has been won. And history tells us that once these key psychological levels are secured, the next leg up is inevitable. Maguire is projecting $3,300 in the near term, with a potential surge to $3,500 by the end of the year. And if this liquidity shift continues, even that could be conservative. And then there's silver. The same game is playing out, but on steroids. Short sellers are trapped, the 4-year supply deficit is deepening, and the physical market is closing in fast. The battle for $34 silver is raging right now, but once it's breached, liquidity providers see little resistance before $38. And with Basel III compliance forcing real price discovery, the artificial suppression in silver could snap hard. We are watching a historic moment unfold in the precious metals markets. The cracks in the system have been visible for years, but now the dam is breaking. Physical gold and silver are reclaiming control, and the financial elite know it. The window to get ahead of this move is shrinking fast. The question is, will you be ready when the breakout hits? The gold and silver markets are shifting in ways we haven't seen in decades. With central banks racing to secure physical reserves, institutional investors pouring billions into gold funds, and supply constraints tightening, we could be on the verge of a historic price revaluation. So, what does this mean for you? Are we witnessing the early stages of a gold and silver supercycle? Let me know your thoughts in the comments. If you found this analysis insightful, don't forget to hit that like button, subscribe for more deep dives, and turn on notifications so you never miss an update on the evolving financial landscape. Stay ahead of the curve. I'll see you in the next one.